Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry is unique because he understands the academic research world as well as the practical world of investing. Today, we're going to discuss chapter 9 from his recent book, Enrich Your Future, The Keys to Successful Investing. This chapter is called The Fed Model and the Money Illusion. By the way, this wraps up part 1 of the book, which is how markets work. Larry, take it away.
Thanks very much. Good to be back, Andrew. So in 1997, Alan Greenspan was giving a speech in front of Congress's regular report as chairman of the Federal Reserve. And he happened to mention that some research, I guess either he or his staff had done, says there was a correlation between the changes in the PE ratio and stock returns. Okay. And relative to the changes in the bond market. So it somewhat makes sense, right? Higher bond yields, people would think, mean more competition for stocks, and therefore maybe stocks can't do as well. All right. Now, the problem is, first of all, one of the things we've talked about is just because there is a correlation doesn't mean that there's causation, right? It could be an illusion of a reason for that correlation to exist. So people form opinions just because there is a correlation, but there may be no substance behind it. Edward Yardeni, who was a market strategist for a leading Wall Street firm, took those comments and he hypothesized that the Fed was looking at this measure, okay, and we'll talk about it, as a way to determine if the Fed thought the stock market was either under or overvalued or fairly valued. I don't know why he would make that conclusion, because first of all, the Fed has never made any decisions, to my knowledge, based on interest rates, based upon stock prices. They make it on inflation and economic growth, not stock prices, right? So the first problem that we have with this Fed model, and I'll describe it now, is they said, let's take the bond yield, okay, and let's say the bond yield is 5%. Then if we invert that, we get a PE ratio of 20, right? Divide 5 into 100. Or you can create an earnings yield and you'd have 5% with a 20 PE. So if stocks are trading above 20, then they're overvalued. They're trading under 20, they're undervalued.
So in other words, using the government bond rate as kind of a comparative benchmark.
Right. And
Okay.
because they do compete for investors, right?
Yeah. Well, for instance, if the bond market, going back to what you said at the beginning, if the bond market, let's just imagine the bond market was yielding, well, I have an example that's kind of an interesting one. One of my friends went during the 2008 crisis. He gathered up all the money he could get and he bought Icelandic bonds at a 20% yield for 20 years. And the currency of Iceland wasn't in the EU, so the currency had also collapsed completely. And his hypothesis was that he would lock in a 20% yield. Yes, it would be in the local currency, but the currency was so bombed out that he felt that that currency would eventually appreciate and he would get an additional return from the currency. And so when government bond yields are super high, in theory, if an equity investor could lock in an equity type return in a risk-free asset, it doesn't seem like a bad idea.
No, except that in Iceland's case, it wasn't a risk-free asset, right? For a U.S. investor, U.S. Treasuries, are a riskless asset if you're buying it to the maturity that you have a certain dollar amount of payments to. Okay, so here's the first problem, as we discussed. Just because there is correlation, it doesn't mean there is causation, right? I think we've mentioned on our calls before, you can have data mining results like David Leanweber. He just took a database from the UN and ran all the data and said, tell me what's the best predictor of the S&P 500. And he found out it was butter production in Bangladesh. Now, no rational person would make investment decisions on U.S. stocks based on that, because they would understand that there's really no causation happen. It's just if you run a million different, metrics, something will show up.
And
That's
that's
why
also before that, 20 years before, it was the length of skirts, of mini skirts, as I recall.
there you go. And then there were whether the NFL, the original NFL teams or the AFL teams for American professional football one, all this kind of nonsense.
And that
right?
isn't that one of the things that you highlight in your book about factor investing, is that the factor has to make logical sense.
Yeah, exactly. For you to have confidence in it.
Yeah.
Right. Okay. So that's the first problem. And what happened is when Yardeni made this hypothesis, you would hear this quoted all the time, even though the Fed never acknowledged it. And we know the Fed doesn't make decisions on it, but there is seemingly some logic if you don't have a good understanding of economics. And just some simple understanding of economics creates an understanding to show why this is what is called the money illusion, or at least I've used that term here, but others have as well. And we'll walk through why that's the case, because it's an illusion, because you're comparing two things that don't have the same impact from inflation. Okay. So nominal bonds, which is what we're comparing the PE ratio to, right? We're going to compare it to, say, a 10-year or a 20-year treasury bond and see what that. So nominal bonds are impacted by rising or falling inflation.
And you're saying nominal bond yields.
Nominal bond yields, and then, of course, the prices.
Yep.
If you get rising inflation, then what happens? Then the yield has to go up and the price goes down. If you get falling inflation or inflation below what was expected, then yields will tend to fall. But stocks, that should have no impact. And here's why. Because we do know that over the long term, not in the short term, but over the long term, and this is something we've discussed before as well, that corporate earnings are aligned with nominal GNP growth, which makes sense. If, for example, we think on average corporations earn 10% of all of the GNP as profits, then higher inflation pushes the nominal GDP up and it will push corporate profits up, right? So if let's take, go ahead.
The underlying thing too, if we just go at a very micro level, companies, management teams, when they get rising prices into their rising raw material prices, they're doing everything they can to try to either become more efficient to absorb those rising prices and maintain their margin, or they're going out and raising the price on of their final product. And therefore, you could think of corporations generally as passing through inflation, not absorbing it.
No. We know roughly U.S. corporate profits have gone up something like 6% a year, 3% GNP growth, 3% inflation, no magic. So corporate earnings should move with the real rate of interest, not the nominal rate of interest. And so let's walk through this example. So let's assume that we expected GNP growth of 2% and 3% inflation. So what would you expect that roughly the long-term treasury bond is going to yield?
5%.
5%, right? Now that would say, under this Fed model rule, that the fair value of the S&P or the market would be a 20 PE. Okay? Now, if interest rates fell to 4, right, what would be the fair value?
25.
25. Now, let's see if that makes any sense. Now, some people say, well, Larry, that obviously makes sense. We now have less competition because yields are only 4, so stock prices should be higher. But that's completely illogical because it fails to account for the fact that corporate earnings are impacted by inflation and or GNP growth. So how do we get the yield going from 5 to 4? One of two ways. Either it's inflation going down. So if inflation goes from 3 to 2, we would expect the yield go to 4. But what's going to happen to corporate earnings? In nominal terms, they'll come down 1% because inflation is less, right? Now let's look at the other side of that coin, and let's say yields go down because real GNP is falling. In this case, let's say it went to 1%, not 2, right? So now you'd have 1 plus 3% inflation, you'd have 4. Well, what's going to happen to corporate earnings if the economy is slower?
They're going to slow.
And we know that in the long term, they move pretty much in line with each other.
So to summarize what you've said, what you're saying is that we have two factors that can be considered. It's either a change in expectations about inflation or a change in expectations about real GDP growth. And both of these things would have a direct impact on corporate earnings. Corporate earnings is going to come down, whether it's inflation or a slowing economy.
Right. Now, let's show you the other side to show you how silly it is that people believe in it. And you still even hear this quoted fairly frequently on Bloomberg or CNBC. So let's say we get a stronger economy for whatever the reasons, right? Could be fiscal stimulus, could be, tax policies change, regulatory rules. The economy is doing better. It's coming out of a recession. Companies are restocking, building inventory, hiring, right? What happens to demand? Going up, right? So companies have to hire people, employment goes up, wages go up, inventories get stocked, you get investment. What happens to the demand to borrow? Goes up. So interest rates go up. Well, corporate earnings are going up. So why should stock prices be lower? There really are this competition between the two. Just because you have rising interest rates doesn't mean that the market is now, undervalued or not fairly valued, or in this case, it would be overvalued, right? Because of the higher rates. So you have to look at both pieces of the coin.
So let me just summarize that. What you're basically saying is that interest rates on government bonds would go down from, let's say, 5 to 4%, and interest rates would go up from 5% or some 4% to 5%.
Well, let's go this way. Let's start at 2% real and 3% inflation.
Okay.
Let's
5%.
say we now get a stronger economy, right? So we get 3% growth instead of 2. What's going to happen to the long bond? It's going to jump to 6. But so that means the PE ratio should be 16.7. Why? First of all, the risk premium for stocks should be going down, right? Because the economy is stronger, less companies will go bankrupt. Corporate earnings are going to be higher. So why should the stock market go down just because yields are rising? In fact, we have a perfect example of that in the last 3 years or so, or 2 years, since the Fed started raising interest rates. What's happened to the stock market? Now, I'll show you one other interesting thing to show you how silly this idea of the Fed model is, and yet gets quoted by market strategists and others often, and investors tend to believe it. What at the peak of or the bottom of the recession caused by COVID, Treasury longer bonds were yielding, let's say 1%. What should be a fair value PE ratio under the Fed model?
Geez, 100. What is it?
100. Does anybody think that makes any sense? No, right? So it can't be right. And yet so many people leave. Let's sort of summarize it. What you have to look at is, the research here. And Cliff Asness did a paper, and he looked at this relationship between nominal yields and stock return, and there wasn't any. It doesn't exist. So why Yardeni and others quote it when it's not in the research either? There's no evidence to support it. And we just gave a great example, right, of in the last 2 years, okay? But we do know that real interest rates matter. And so we look at the Cape 10 and look at real earnings over the longer term, right? And when you invert the Cape 10, so if the Cape 10 today, let's say, is 30, we know that that's telling us that the expected real return to stocks is 3.3%. So we're now looking at a real number, and then you could compare that to the yield on tips, another real number, and you can make a decision based upon your own ability, willingness, and need to take risk, whether you want to own stocks or not. Is there a big enough risk premium? If the Cape 10 is 30 today, so you'd have 3.3% earnings yield, and the tips yields out that far are, let's say, 2%, well, you're only getting a 1.3% equity risk premium relative to tips. And you have to decide whether that's an appropriate return for you to take the risk of equities or not.
So just to go back to the CAPE ratio, which is generally, we would say, the price today relative to the average earnings over the past 5 or 10 years.
Adjusted for inflation earnings. Right. See,
I never knew that about CAPE. I didn't know that.
Adjusting for inflation. So it goes back 10 years. Let's say that 10 years ago, inflation since then was 40%. So if the companies earned $100, they would call it 140. So inflation adjusted to make it like a real earnings number, right? And then it averages it to take out the cyclicality, right? And that now you're using a real number in earnings, right? And a real number, you then can compare it to the tips yield and look at that. But also, when the Fed model doesn't say anything, notice, about the expected return to stocks. All it said, even though it's wrong, was that stocks were either under or fairly valued, so people could, in theory, use it to time the market, right? It didn't tell you anything about future stock returns, where the Cape 10 has about a 40% explanatory power, which is pretty high, gives you, but again, you can't even use that to try to time the market. You would have done very poorly over the last 30, 40 years trying to use it.
I've looked at the Cape 10 for many years, and I didn't realize it was adjusted for inflation. The earnings are adjusted for inflation.
Yeah.
And I'm just looking at it now, and I see that. So yeah, that's really helpful. Well, that's quite a wrap up on this first section. I think it's just important to kind of go back and think about what we've talked about in this part one of how markets work, because we were looking at how security prices are determined, why it's so difficult to outperform, right? We looked at risk and return on stocks and bonds. We looked at how markets set prices. We looked at persistence of performance and why it's hard to outperform, and just the competitive nature of what you're competing against. When you enter the market, you're competing against, the best wisdom all accumulated into today's price. You've also told us about how great companies don't make high return investments. and market efficiencies. We talked about Pete Rose and just, again, how hard it is. And we saw the value of security analysis, which I'm sorry to say doesn't add value, unfortunately. And then we talked about last time, be careful what you ask for. And now we're trying to understand that be careful, particularly understand the way I think about the Fed model and the money illusion is make sure you clearly understand the difference between real and nominal, number one. And number two, also clearly understand that a corporate earnings, basically, whether it's real GDP or inflation, it's going to match those. So it's sort of a pass through. It is ultimately the economy and the GDP. So is there anything you would add to all of that sum up?
Yeah, let me add one other comment just to make sure the audience doesn't think security analysis has no value. It has no value in your ability to outperform the market because we don't know, we can't identify the analysts who can predict better than the collective wisdom of the market. But security and analysis adds tremendous value because their insights help inform stock prices, and that tells you how capital should be allocated, right? If companies were overvalued because people were misjudging the future and overestimating, in general, companies' ability to generate earnings, then capital would get allocated inefficiently to bad industries, like happens in communist countries. But tends not to happen here. So the value is in their seeking information and trying to find the right price. They are, in fact, making the market efficient. It's their efforts in setting prices that really makes markets work. It's just the competition is so hard to beat the collective wisdom of the market.
Yeah, and I guess one way to think about that is the extremes. Let's go back in time where there were no passive funds. It was all active. And let's go forward in time and imagine that we were all passive, 100%. There are no analysts anymore. Both of those extremes are not the best outcome for the overall market because, all the things that we've talked about.
Right. Now, the one thing, obviously, that's never going to happen. There'll always be active investors. But even if there weren't, there'd still be stocks traded because people die and assets have to be sold. They need to live. We also have companies buying other companies. So there will always be some trading, but we need active managers. So we have to keep it a secret that passive management is the winning strategy. We need those active guys to keep the market, one, liquid, keep trading costs down, and to make the market efficient so we become free riders and don't have to pay their expenses. We'll let the people playing the losers game, let them bear all the expenses of those analysts.
Oh, okay. And on that note, let's just briefly look at part 2 of the book, which is strategic portfolio decisions. And our next chapter, chapter 10, is when even the best aren't likely to win the game. But just, what should we expect in the strategic portfolio decisions, part 2 of the book?
Yeah. So there's a whole topics here about helping you decide what is the winning strategy, active or passive investing, and why is that true? And thinking about what I call the difference between risk and uncertainty. Risk is where, like throwing the dice, you know exactly the odds. Risk is also, or it's at least very close to risk, life insurance companies who can estimate using demographic data the odds of a 65-year-old couple's second to die life expectancy. It's not perfect, right? They can't know what future science inventions can extend life, whether we have a global pandemic that might shorten it, but they can make good estimates, right? But uncertainty is things like an oil embargo, a nuclear war, things like that, a COVID incident. There's no way to estimate those things. So you have to look at what tail risk can come up and how do you insulate a portfolio as best you can or insure it against that tail risk of those things? And how do you build a portfolio knowing that there are no crystal balls that allow you to foresee the future?
Yeah, it's exciting because, we've kind of set the foundation in your first part of the book. And now we're going to think about the application of constructing the portfolios. And I like in the end of the part 2, you're talking about, how do we need to think about, black swan events? As you mentioned, there can be some very extreme things and also questions about gold. And I know you've recently done some work on that, which was really interesting to read. So I'm excited for that section. So Larry, I want to thank you again for this great discussion, and I'm looking forward to that next section in the next part of the book. And for listeners out there who want to keep up with all that Larry's doing, just follow him on Twitter at Larry Swedroe or on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.